Welcome everyone, this is Thomas from TradeWin. It's been a while since my latest video, so today let's focus on how to choose your prop firm challenges. So first, I will make a quick recall on what are prop firm challenges. The idea of prop firms is to allow traders, individuals or companies to access leverage, meaning you pay a small amount of dollars to get buying power which is much greater. So let's take an example. You are buying from a prop firm a 200k account with a 10% drawdown and it costs you $1,000. This is exactly the equivalent of getting an account with 20k, which is what you are allowed to lose if you want to follow the balance-based drawdown 10% threshold, and it costed you $1,000. So this means that paying $1,000 you get access to $20,000. So in that example, the leverage you need to understand is times 20 in what you can afford to lose, and the global leverage is times 200 because you have a 200k account. So that's the main interest in working with prop firms, is to get leverage. So what you need to know when dealing with a prop firm is that all is simulated. All your accounts are demo, which means you never trade directly within and you never interact with exchanges. Even when you are funded, all the accounts you have are, I would say, fake. Okay, it's not real money that is at work. That's really important to get. Contrary to if you open an account to, for example, Interactive Brokers, and you deposit $1,000 and you are starting trading, therefore you are going to hit the real exchanges. Okay, when dealing with prop firms, you will never actually really trade in real markets. It's all simulated. So the last thing really important to get in mind when you deal with prop firms is that this industry, which is getting bigger and bigger, takes advantage of losers. The economic model of this industry is that everyone pays to do challenges. So a challenge is defined as a target profit you need to reach, respecting some drawdown limits that are might be global, that might be daily thresholds, and depending on the nature of the drawdown, there can be some different types here. But the main idea is that everyone pays for challenges, and most of the, let's say, traders don't get through this challenge phase and never get funded. So beware with what I said previously, you never really get funded. Meaning that even if you pass the challenge, you will never get assigned a real portfolio with real money. Okay, it's not working this way. And this money people pay for challenges is used for payouts to the winners that get funded and that make money. Okay, so this industry only works because there are much more losers than winners, because losers keep losing and winners don't win too much. Okay, we already saw in the prop firm universe that some of them just stopped doing business, they just closed. So everyone had just their account suspended with no payouts and all challenges cancelled. It can happen when the economic model is not profitable enough. So when I say losers lose, we have some statistics about that, and roughly 74 to 89% of new CFD traders, so CFD stands for contract for difference, which is the main, I will say, asset classes you will trade on prop firm challenges, lose money. Okay, that's the case in Europe, and I guess that all over the world is exactly the same. And according to one prop firm, maybe you can find this one if you already purchased a challenge from it. It explicitly says that only 9 to 12% of people passing challenges really get funded, but we don't have the statistic for people really getting payouts and how often and how much do they get their payouts. So you need to keep in mind that only a very, very little part of all those challengers finally get money from this prop firm industry. So to name a few, this is the list I retrieved from Prop Firm Match. You can find lots of really well-known or less-known prop firm companies. It's a really growing industry. So here is the main part of my video, how to choose prop firm challenges. So I will give you some things you need to consider when thinking about purchasing a challenge. You will see a lot of people defending such prop firm or maybe another one. Here are objective, I would say, criteria you need to keep in mind when choosing a challenge. So let's start. But before that, keep in mind that it's not because you are trading a prop firm challenge that you will be profitable. Okay, we already saw that 90% of people, up to 90% of people lose. Don't try to pass a challenge if you don't have any strategy. Okay, you need to do the homework first, the ugly work, the work in the dark nobody sees, and when this is done, then you can think of scaling and getting some capital. But passing prop firm challenges is equivalent to looking for leverage, looking for capital. You only do that when you know you are fine with your strategy. That's exactly what I said. Don't purchase a challenge just to do like other people you see on social media. You're about just to blow a challenge and waste the money you hard earned. Let's go. So the first perspective I will detail now is in the prop firm universe. You have mainly two categories of products you can trade. You have one side which is futures and the other side which is CFDs, contract for differences. And depending on your strategy and what you want, one choice might be better than the other one when choosing between a future prop firm challenge or a classic prop firm challenge using CFDs. So let's go. The first question you might ask yourself is, what asset class do you want to trade? So here, no specificity, because you can roughly trade whatever underlying you want, either via futures, which is the instrument, or via CFDs. So everything is quite the same here. The next criteria you need to keep in mind is, do you need spreads to be tight for your strategy to work? Because when dealing with futures, you have a really high confidence in the fact that spreads are small, they will keep being small, and they are quite constant over time. Okay, if you trade, I don't know, ES futures, which are the S&P 500 futures, you can be certain that most of the time you will have a 0.25 point of spread, and maybe if there is a lot of volatility you will get to 0.50, but that's all. It will never get bigger than that. However, when dealing with CFDs, you can have higher spreads. Okay, you also can have what we call I just forgot the name, slippage. Yeah, I found it. Slippage, that's just a way to wreck your account and wreck your entry for any trade. So the main idea here is that if you are trading the lower time frame, you want precision entries, you would prefer to deal with futures instead of CFDs. That's my view. You can disagree with that, that's fine. But to have already traded futures in the lower time frame, when I say lower time frame, is like 1 minute time frame. I never go lower. If you go lower than 1 minute, there is no debate. You absolutely need to trade futures. And even if trading the 1 minute time frame, I cannot see how you can be profitable trading CFDs. Okay, so that's my idea, and that's the next point. Which time frame do you want to trade? Futures are suitable for precision trading, and most of the future prop firms require you to close all positions by the end of the day. So it's futures trading equals in prop firms to day trading. Okay, if you are trading the higher time frame, then CFDs might be a better option. That's my view. And also, if you even think about trading on the longer time frame and holding trades overnight and over the weekends, you definitely want to trade CFDs. You can even avoid all the swap fees with a kind of add-on when you're purchasing a challenge. Today, most prop firms allow holding overnight and over the weekend. Can be an add-on, as I just said, and you can avoid the swap fees. That's a nice feature I always use. And as I said, if you want to trade overnight or holding overnight, you can't trade future prop firm challenges. Another question is, do you plan to copy trade your account across different prop firms or across different accounts from the same prop firm? So I've tested different trade copiers. The TradeWin one, for example, for futures, and I confirm that an excellent tool for copying and executing instantly your trades on many accounts. Okay, and I'm not even it's not multi-broker compatible, but it's multi-prop firm compatible. If you have a TradeWin account with, for example, Apex or TopStep, you could use the TradeWin trade copier to trade both accounts at the same time. I never used NinjaTrader, so I can't really talk about that, but I heard it seems good, but it's paying. Yeah, that's right. For CFDs, I have used Traders Connect, which is paid. You pay depending on the number of accounts. It's like $100 per account per year if you pay yearly. And the idea is to allow copy trading across different platforms. So you have MT4, MT5, CTrader, and DXTrade. And I don't recommend using this trade copier for low time frame strategy. If you want to trade the 1 minute, as I say, between the time you execute the trade on the master account. Even if the execution quality is great, you have like 50 milliseconds to wait until the trade is sent to the other side. I don't like the idea of relying on high spreads and possibly slippage across all my accounts at the same time. So that's my view. There is also the social traders tool I'm not familiar with, but seems cool. So once we talked about those criteria which were focused on your strategy, now we need to focus on the specificity of the challenge. Okay, the challenge has some specificities, and you perfectly need to understand each of them to be really precise. So let's talk about balance-based drawdown. So here is a table, and I will only talk about the example because it's self-explanatory. Imagine you have a 100k account. Overall drawdown limit, which is balance-based, is 10%. This means that your account will be deactivated if the balance or equity at any time goes below the 10% mark from the initial balance, which is 90k. Okay. Imagine that you make a 5k profit on one trade. The balance at which your account is deactivated remains 90k. It doesn't update. Okay, that's the balance-based drawdown overall limit. When this balance-based drawdown is set to it's set daily. Okay, so this corresponds to the max percentage you can lose based on the initial account balance per day. You have a 100k account again. Daily drawdown limit is 5%. If you lose 5k in one day, even if you are above 90k, you will be breached. Okay, your account will be deactivated. And this 5% threshold is reset every day. Okay, so this is balance-based drawdown. Equity-based, also called trailing drawdown, is a bit different, and I will go to an example just after that to illustrate this because it's less obvious. You have again a 100k account, and let's say the trailing drawdown is 6%. Your account will be deactivated if the difference between your max unrealized gain and max unrealized loss is greater than 6k. Okay, the main point here is about unrealized. So I will just highlight this because this is the info you need to really get in mind. When we talk about equity or trailing drawdowns, we talk about unrealized gain. So let's start again the slideshow. Let's go. So imagine you take a trade with a profit target of 6k. Okay, imagine that the position starts to get profitable. You have a 5k but unrealized gain, and let's say for whatever reason the trade reverses and then you have a loss at 1k. Okay, because the difference here is 6k, which is the trailing drawdown, your account will be deactivated. That's what it means. Okay, so you need to be aware each time, of the equity. You need to be aware of the equity, which is the real-time value of your account with unrealized gain and realized gain or losses. Okay, so trailing drawdown is just the safety net that follows the highest equity point. Okay, and that's totally crazy. I hate challenges personally with these kind of drawdowns. So let's explain what happens let's say I have a great trade opportunity. I'm targeting a 10-hour profit, completely crazy, and my risk is 1% of the account. Okay, and this is the evolution of my equity curve when time passes. So here I'm entering the trade. I see that I get in profit. Let's say then the trade reverses for some reason, gets down, and then reaches my target of 10 hour. Okay. When you are dealing with an equity-based drawdown, I keep the 6% mark, okay? Because here I have a 6% difference, my account will be deactivated at this point. Okay? That's completely crazy as a rule, okay? However, yeah, in the balance-based drawdown, I don't care of my open trade results as long as I don't, would say, lose the daily, the overall daily balance. This trade is completely fine. Okay, I will reach the target and make 10R. You perfectly need to understand. So everyone here trading equity-based or trailing drawdowns, this is a subject. Okay, this is really important to understand. So a way to avoid this kind of scenario, you can fix lower targets. For example, a risk to reward 1 to 2, for example, to avoid the possibility of a trade reversing, still not hitting your stop loss, and getting bigger than 6% of the overall account. So please don't lose accounts because of that. It would be a pity. So finally, according to the drawdown type, I believe, that's my view, that challenges with trailing drawdowns are harder to pass. Vast majority of future prop firms use trailing drawdowns, and some forex prop firms use balance-based, but not all of them. You need to be really careful about that. Go to the FAQ of each prop firm and ensure that what you're buying satisfies your requirements. That's all for this video. In my next video, I will like to share with you how I am setting up my 2 million prop firm challenge. So this is my next challenge. I've purchased a bunch of challenges, and will explain to you how I chose them regarding what I'll explain in this video, and I will keep you aware of what I'm doing with this challenge. So thanks a lot for getting in this video, and see you soon. Goodbye.